Crash of American banks presented by the finest forever. The 10th of March 2023, Silicon Valley Bank, 16th largest bank of America collapses. And this one news shakes the whole world. Year 2008, after the crash of Lehman Brothers, this is the world's second biggest failure. And this thing is so dangerous for all of us, that you can't even imagine. The 10th of March 2023, Silicon Valley Bank of US collapses. And right after 2 days, Signature Bank of US also collapses. And right after 3 days, the share price of First Republic Bank falls by 52%. Recession is just around the corner. Neither startups are getting funding nor businesses getting loans. And after some time your company may fire you. A rough week for the banking industry, the collapse of Silicon Valley Bank, the second biggest bank collapse in US history. The Silicon Valley Bank collapses last week is creating a domino effect across the banking industry. Silicon Valley Bank is no more. But, the question is why? Why is all this happening? In just 48 hours, why the 16th largest bank of US collapsed? And how would this one incident impact our country? And most importantly, how badly it can impact our life. And let me tell you, this is just the starting of a disaster. Let's go back in time a little bit. All this started in year 2010. This was a time when it had been 2 years since Lehman Brothers crashed. Worldwide economies were recovering, and to push it more speedily, venture capitalists started investing a lot of money in US, Indian and Chinese startups. And due to this, the banks where startups used to deposit their money, or from where they used to take loans, all those banks started competing to be the largest bank. And this was the place from where the end of Silicon Valley Bank started. So to understand this, first of all let's understand, what does a bank do to make money? So if you look very closely, if we look at the model of making money of bank makes money in 3 ways. Number 1, loans. Bank gives loan to peoples, companies and other banks. Number 2, services. You must have seen that banks give mutual funds and insurance services. Along with that, credit cards, bank charges, there are annual maintenance charges of the bank account you use, and along with that, ATM withdrawal charges. And for many such services, bank charges money. And number 3, securities. Bank make money by selling securities like bonds, bills, certificate of deposit, letter of credit, derivatives and even letter of undertaking. So whenever a bank deposits money in any of these securities, they get interest in return. So if we talk about crash of Silicon Valley Bank, there are 2 types of securities involved in the Silicon Valley Bank crash. Number 1, held till maturity security. And number 2, available for sale securities. So what is the difference between these 2? So see, the available for sale securities, you can sell them anytime and you won't have to bear any exit load. Whereas the held till maturity securities, if you sell them before a certain period of time, means that if the holding period is of 10 years, if you sell before that period then you would have to bear heavy exit load. And in this case, SVB had held till securities worth $91 billions. Now the question is, how did they get $91 billions? Whose money was it? Startups. Most of the amount was of startups. And this thing came as the biggest problem for this bank. But why? The answer is hidden in money-making model of startups. If you look at the money-making model of any startup, then this is how their money-making model looks like. First of all comes cash inflows. Means where does the money come from? If you see, either startup takes money as bank loan, or they get money as return from the capital they have invested, i.e. capital gains. Third, their money comes from customers. And most importantly, venture capitalists. Whereas the second part is cash outflow. Where startup does spends its money after getting money. There comes startup operations. These startups invest money in other startups. And third, bank. The extra money they have, they deposit that money in banks. The biggest role here is of venture capitalists. A venture capitalist invests money in a startup. And when the startup gets money by raising funds, they keep excess money in the bank. In this case, that bank became Silicon Valley Bank. But why? So, SVB, to attract startups, companies and other people so that they deposit money in this bank, they gave 2 33% interest rate on their deposits, which is higher than the interest rate of other banks. If you compare, other American banks who used to give 1.73% interest rates on their deposit, whereas SVB started giving 2.33% interest rates. So when the interest rate would increase, who would get more customers? SVB. Here the venture capitalists who are giving so much money to these startups. Where does that money come from? So see, if you study the model of a venture capitalist, you will see, venture capitalist creates a huge VC fund. And there are institutes, governments and limited partners. And all of their money creates a huge VC fund. Through this fund, a lot of money is pumped in many startups. After that, when the startup's valuation is pumped, then the profit that comes from selling the stake, some portion of that profit and the management fee, which is a venture capitalist such as Sequoia Capital, that portion would go to them and rest profit goes back to the investors who put money inside the VC fund. 2019 to 2021, these 2 years proved to be tremendous for Silicon Valley and SVB Bank. Because at that time, because of COVID pandemic, new opportunities have opened up for startups to grow at a faster pace. To take advantage of which they needed funding. Now the thing is, because startups had such a huge valuation growth opportunity left, so they started raising a lot of funds from VCs. Now when such a huge amount came, then it is obvious, suppose if a startup raises $500 millions, so in that scenario, it won't spend that money in one time. It would be used in over a period of time. And where would they keep the money? In banks. So the thing is, if a startup has to keep $500 millions in bank, then it will put the money in the bank which is giving highest rate of returns. So here in this case, that bank became Silicon Valley Bank. Who was giving 2.33% interest rates on its deposits. Due to which it attracted a lot of depositors, so where in 2019, SVB has deposits worth $64 billions, the same deposits reached to $189 billions by year 2021, because of high interest rate and heavy VC funding. And such a huge deposits became problematic for bank. Why? Because the people who has deposited the money in the bank, whom the bank has promised 2.33% interest rate, where would the bank give from? Bank would have to give this money as loan to give money to people. But the problem is, these $189 billions, this is such a huge amount that it is not so easy to give that money as loan. Why? Enough people should have to give such a huge amount as loan. So SVB chose this model to invest these $18 billions. First of all, they started giving net loans of $76 billions. Means, they gave loan to people. After which, they kept $13.80 billions as cash. And last and most importantly, the biggest amount went in securities. And SVB invested money in 2 types of securities which I told you in the starting. Number 1, available for sale security, in which SVB invested $26.10 billions. And number 2, head to maturity securities, and its amount was $91.30 billions. Now this long-term low liquidity asset SVB had invested more than $90 billions. But the problem was its return was 1.56%. But wait a minute. SVB had promised 2.33% returns to its investors. But held to maturity securities are giving just 1.56% returns. So here, the bank is facing loss. Right? But there is a catch over here, and that is unrealized loss and realized loss. So for example, this is your stock portfolio. So if you look in your portfolio, so suppose you have Reliance stock and it gave you a profit of 500 rupees. And you have HDFC stock and it gave you a loss of 700 rupees. You have lost 200 rupees in Adani Wilmar stock. Axis Bank has given you a profit of 300 rupees. But again Infosys has given you loss of 300 rupees. So if you see total, your profits are 800 rupees and losses are 1200 rupees. Means your adjusted net loss is 400 rupees. Now here if you sell all your shares, then it becomes your realized loss. Means that you have realized that loss. But if you don't sell these shares in that case, this loss would be your unrealized loss. means that this is on paper. You haven't realized this loss. So in the case of SVB, if you look at this chart very carefully, not just SVB, unrealized losses of all big banks of US are happening because of held-to-maturity securities. And this amounts to $650 billions. If such a huge amount of all banks of US banks is invested is held-to-maturity securities, then why did just SVB collapse out of all banks? JP Morgan, Bank of America, Wells Fargo, why did all these things didn't happen with these banks? To understand this, we have to go back in time a little bit again. As soon as the pandemic ended, the demand which was less had started increasing rapidly for goods. Due to which demand pull inflation came. Because demand has increased and supply is limited. So the prices of things started increasing. Secondly, during Russia-Ukraine war energy crisis came, due to which the prices of petrol and gases reached to their all-time high. As a result of which, the transportation cost increased. Due to which, cost-push inflation came in the whole world. Means that things have become costly because of one particular thing. Look at this chart carefully. It tells that the inflation which was 1.8% in early 2019 it reached to 7.9% by 2022. And this is the highest in last 40 years. Due to which everything became expensive. So to curb this inflation, whenever such a situation arises in any country, the central bank of that country, like RBI in India and Federal Reserve in US, it does these two things to grab the money that is in the economy. Number 1, sell government bonds and securities. Government bonds and securities are launched at very attractive prices in the market, so that the people purchase the bonds from the money they have, and central bank can get the money and people get the securities. Number 2, repo rate and reverse repo rate are increased. Repo rate is the rate on which the central bank gives money from commercial banks. Reverse repo rate is the rate on which the central bank takes money from commercial banks. When both of these are increased, then the loans taken from commercial banks are reduced, because of increased repo rate and interest rates. Whereas on the other hand, because central bank is offering an attractive interest rate, then commercial banks start depositing their money in central bank. This happens because of which central bank pulls out most of the money from the market. And this is what Federal Bank of US did. Look at this chart very carefully. By the end of 2022, repo rate of US has hiked up to 4.375%. And due to this, the startup economy of US, this is what started happening. Now because repo rate has increased, commercial banks are getting loans on high interest rates. So banks also increased their interest rates, due to which the startups which used to take loan from banks, now they started taking less loans. A part of them, LP and institutions, who used to invest money in VC, and through which VC used to invest money in these startups, they started investing money in government bonds and securities. Why? Because the government has introduced new government bonds and securities, at high interest rates, and the risk there is also low. So LPs, instead of investing money in startups, they started purchasing all these things, because it became a better option. So the funding in startups started drying up. Due to which a cash crunch came in these startups, and when this cash crunch came, the money which these startups had deposited in their banks, they started withdrawing that money from banks, and that money was in Silicon Valley Bank. So basically the cash in hand in SVB was very limited. But the demand of cash they were getting was very high. Why? Because SVB had invested $90 billions in held-to securities. So to meet this cash requirement they had to liquidate this money, and due to which the tenure of 10 years of long-term maturity bonds when they broke it down quickly, so they had to sell those bonds in loss. So basically the cash in hand in SVB was very limited. But the demand of cash they were getting was very high. Why? Because SVB had invested $90 billions in held-to securities. So to meet this cash requirement they had to liquidate this money, and due to which the tenure of 10 years and they also started withdrawing their money. And the big investors of SVB Bank, they started withdrawing their securities within 48 hours. Due to which a big panic situation was created. And as you know, when a bank collapses like this, so people whose accounts are in other banks, they also start withdrawing their money with the fear that our money is also in danger. People are laid off. Because see, when there is less money in US market, floating of money decreases worldwide. Because a lot of startups and companies are directly or indirectly dependent on US for investments and businesses. So first of all, their revenues and cost effects get affected. And when it happens, companies focus on controlling their cost. This is not about just this situation. You should have enough money for your expenses of 6 months, so that you can survive for some days in the worst situations. And this emergency fund would help you to fight that situation. Number 2, pay close attention to warfares. Whenever there is a war situation in this world, then just because it is not happening in our country, it doesn't mean that it can't impact our country. So please, thanks for watching The Finest Forever. Subscribe, like and comments.